It's Wednesday night, and something just feels off.
And yet, at the end of every month, there's never enough left.
You're not making obvious mistakes. Nobody taught you the rules.
My name is Milo, and today that changes. 10 rules finally explained.
Meet Sarah, 28 years old, $65,000 a year, thinks she's doing okay. She checks the balance, sees the same number, figures everything is fine.
It isn't. Sarah's $4,000 bank balance on screen. That $4,000 is losing value right now, even though the number looks the same.
Inflation means prices rise over time. Since 2020, up 25%.
It's like leaving an ice cube on the counter. You walk away, it looks fine, but over time it melts away. Same with Sarah's savings.
You come back an hour later, and it's smaller. That's your savings.
The bank pays you 0.01%. Inflation takes 2 to 3. You are losing money.
Keep 1 to 2 months in checking. Move the rest to a high-yield savings account.
You earn interest. Then you earn interest on your interest. The base keeps growing. Warren Buffett is worth $100 billion. 99% came after his 50th birthday.
He didn't get smarter in his 70s. He just let the math run long enough.
Sarah starts at 28. Her colleague waits until 38. Same $200 a month. The difference? $260,000. Not talent, not income, just 10 years earlier.
But flip the snowball over. Compound interest works the same on debt.
$6,500 in credit card debt. Minimum payments. 14 years. She pays $13,000 total. Making minimum payments is like bailing a sinking boat with a teaspoon.
It's not working.
That's minimum payments. No, I'll end up with less after taxes. Every year, real people turn down raises because they think they'll pay more taxes.
Think of it like stacked buckets. Each bucket has its own rate. That's it.
Her raise only gets taxed at the higher rate on that slice. The rest stays the same. See, she keeps most of it. You will never take home less money by earning more, ever. The myth is dead.
There's a 3-digit number following you around, and you might be ignoring it.
That number follows you everywhere.
Same house, same loan. One gets 6.5% rate, one gets 8.5%.
Over the life of the loan, that's $145,000 difference.
Same house.
Over the life of the loan, that's $145,000 difference. Same house.
Pay on time. Keep utilization under 30. Don't close old cards. Check your report.
Not all debt is the enemy. Good debt builds value. Bad debt drains it.
Ask one question. Does this debt put money in your pocket or take it out?
I have a perfect debt plan. Mine's simple. I finished it. Done beats perfect. Every time.
One Thursday morning, Sarah's car makes a sound it's never made before.
Her bad day just became a 4-year interest payment because of one car repair. But if Sarah had an emergency fund, it's just a bad day, not a debt spiral.
Starting from zero, aim for $1,000 first. That alone changes everything. This one number changes everything.
Every dollar you spend has 2 price tags, the receipt and what it could become.
22% APR? That's highway robbery.
And that's just the start. We're in big trouble.
I know.
That $200 invested at 8% over 30 years? $293,000.
Pull up your last 2 bank statements. Find the recurring charges. Cancel what you don't use.
The average household spends $200 to $300 a month on subscriptions. They guess 80. Come on, buy low, sell high! Most people overcomplicate investing, picking stocks, chasing tips, losing money. Own a piece of everything. An index fund buys tiny pieces of hundreds of companies at once. You own the whole market. Buffett bet $1 million that an S&P 500 index fund would beat hedge funds. He won. Boss gives Sarah $1. She puts it in 401k. Employer immediately doubles it. 50% instant return. $2 become $4, become $8. A Roth IRA grows completely tax-free. You pay tax now, never again on the gains.
Contribute, automate, then leave it alone.
Patience does the heavy lifting. Sarah, you've got the promotion.
Sarah gets promoted. Salary jumps from $65,000 to $80,000. Exciting, right?
New apartment, nicer car, better restaurants, nothing reckless, just upgrading.
12 months later, she feels exactly the same.
The treadmill kept moving.
Psychologists call it the hedonic treadmill. Income rises, spending rises to match. The fix? The moment a raise hits, automate half into investments. Before you adjust, she got a raise and built wealth.
You don't buckle it because you plan to crash. Insurance is a seatbelt. You don't put it on because you plan to crash.
Without it, the crash, the hospital bill, and bankruptcy arrive together.
Crash, the bill, and bankruptcy. Lightning bolt, fire, flood, theft scenario. Without insurance, everything gone. That's one takeout order.
Insurance is not where you build wealth. It's where you protect what you've built. Sarah started with $4,000 and a vague feeling something was
Now,
off.
her bank account and credit score have grown, and her investments are thriving.
Now she understands all 10 rules, the operating manual nobody gave her. Pick one thing, not all 10, one thing, now.
If this changed how you see money, subscribe and send this to someone who needs it.